Imagine this. You spend your life building a small business. You make good money during your working years, but come retirement, you realize you don't have enough saved and you're no longer able to work. It's the nightmare scenario for many entrepreneurs, but thankfully, it's entirely avoidable. This entrepreneur turned financial educator behind me is here to explain firsthand how investing has helped him safeguard his retirement and how it could do the same for you. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and we've got a clear message for all the entrepreneurs and small business owners out there. Investing is a business you want to be in. We're going to hear all about how you can build an investment portfolio that can help sustain you after your working years. Let's hear how it's done. Joining us is Robin Valadares. He is the founder of Financially Fulfilled Pro. He's a registered physiotherapist who helps other medical professionals and small business owners about their personal finance and investing basics. Robin, it's great to have you in studio here. Thank you so much for joining us.
Thank you, Rob. Thank you very much for the opportunity to help educate my audience.
Absolutely. You fought through the snowy weather here in Toronto, so we appreciate you coming downtown to join us. And I got to say, Robin, here I am. I can barely run my own life. Here you are, you're running a small business. You're now a financial educator. You got that going. That must keep you very busy. I'm curious, what made you want to get into the financial literacy side of things, being so busy running an actual business?
Yeah, my mom will tell you I'm an odd duck. She'll tell you that. But it was 2 moments in my life. One, when I was like 25 years old, I was exiting my school, about to hit placement, and you're not ready for the real world. And my preceptor at that time, clinical instructor, sat me down like you and I are doing right now. She asked me this question. She said, Robin, look around you and how many professionals are still practicing over a certain age. And if you know anything about healthcare and therapy, it's rare to see our profession working to their 60s or 70s. And I was like, oh wow, I didn't know that. So yes, your tenure of working is short, but your lifespan is long. So how are you going to meet your obligations after you retire? Where did that come from? You can't make it from your income. So that set me on the journey of personal finance at age 25. And then rewind about 5 years ago now, the pandemic hit. Our clinic was closed for 3 months and I was twiddling my thumbs at home. I don't know what to do. I was an adult, but I couldn't work. So I was like, okay, let me take a bet on myself. Let me educate myself so I can teach my peers on the benefits of personal finance because school didn't teach us any of this.
Yeah, it's a real shame. I've heard a lot of people grumble about that. Like, how come we don't learn these things in school? Like, I've never had to calculate like the angle of a triangle or something like that. We learned a lot about that in school, but we don't learn about the basics of personal finance and investing. So really underscore it for us then, for an entrepreneur who, they might be making good money in their business right now. They have this income producing asset and they're thinking, hey, I'm feeling pretty good about retirement. Why do they need to start investing? Why does that need to be part of the financial mix for them?
Simple right off the bat is you likely don't have a pension plan. So you're investing for your future and you're investing in one asset stream, which is your business. But we know we have to diversify in order to mitigate and withstand risks. The pandemic was a great example. You might have a business that it's tickety-boo, but then it gets shut down to no fault of your own. But you still have obligations to meet. So how do you meet those obligations? You need assets or revenue streams. So investing is crucial as long as you make sure your business is set up well. Then is the next step to invest for yourself now and then your future self later on.
I think some small business owners might, and I'm thinking of my father-in-law here who owns a small business too, thinking that they can just work forever and they'll always have that stream of income, but eventually you're going to have to hang things up, right? And you, to your point, you don't have a pension like a salaried employee would. So when you think about the income streams that you wanted to build, paint us a picture here. What does it look like for you now that you did the work to learn all the financial literacy stuff and you've got all these things going?
Yeah, thank you. The challenge for us as health professionals are 2 things. We're very much tied to a location to earn an income. For me as a therapist, I have to be in the clinic trading my time. It sounds bad, but I have to see people on an hourly basis to earn some revenue. So that's a kneecap or a handcuff for me. The second one is very much, it is location and time dependent. So I can't scale time. I can only see so many people an hour, see them so many hours in a day, or work so many days in a week. So I was like, okay, but I'm only tied here. What else can I do on the side to help my cash flow and my assets increase that I don't have to trade my time for it?
And so just give us a sense, what are some of those other revenue streams that you have going on right now?
So through trial and error, I own some rental properties, residential rental properties. I own dividend producing stocks and bonds as well. I own an Airbnb that helps me with cash flow as well. private lending, and then the alternative ones are, we're talking Bitcoin, fine wine, fine whiskey. So those are kind of the non-traditional ones as well.
I'll tell you what, I could never be a collector of fine wines and whiskeys. I would just be raiding my collection too often there. But kudos to you for being able to have the discipline not to get into that, because that can be a really interesting thing. Well, we're going to talk about all that good stuff and more. But let's get into some of the top tips that you have for entrepreneurs here that want to get investing here. Let's get going here. But first, for those in our audience, if you want to get in on the conversation too, we'd love to have you. Make sure you submit your questions to us. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your question. Okay, so I think one of the top of mind things, Robin, for a lot of entrepreneurs is they're like, look, I got to build up my business. That's my main focus. That's where I want to be investing my time, but also where I want to be investing my money and reinvesting my money as they make money. So at what point in the, I guess let's call it the business development process, should they be thinking seriously about starting to invest?
Considering most business will fail in the first couple of years, I think it's wise to make sure your financial house is set in order. So if you're going past that and you can meet your monthly obligations of expenses or have a good idea what your expenses are in the first 12 or 16 months, that's checkbox 1. Checkbox 2 is, can I withstand downturns? AKA, like a pandemic hitting? Do I have an emergency fund? Can I have an emergency fund that A, makes me sleep well at night, because that's a factor, as well as to pay for my obligations or unforeseen obligations later down? So when you have those two, and you're like, okay, now I have cash flow, what to do with it? Then it make sense to start to look into investing.
Yeah, and don't sleep on the emergency fund too, right? Because I think a lot of people, I know even diligent investors, they'll look at it and they'll say, this is just money that's just sitting there. Like, I want to put it to work. I want to do stuff. Or in an entrepreneur's case, I want to put this back into my business, right? I can do this, that, or the other thing. But that sleep at night factor is pretty important.
Massive.
So when it comes to investing then and setting aside some money to invest, we hear all kinds of rules of thumb for an individual, like I'm thinking of a salaried employee, somewhere in that like 10, 15, even 20% range. I mean, you can get more ambitious than that certainly, but that's kind of like the rough rule of thumb. What about for an entrepreneur? What do you think? Because they don't have, to your point, like a pension or like a share purchase plan or anything like that. So how much should they be setting aside, do you think?
At minimum, like you mentioned, 10%. I would be more conservative with the 20%, and it depends on your time horizon, when you were going to retire. Is it a 5-year plan? Then you might be investing 30, 40% because it's right next door, right in the corner. If it's 30, 40 years, you may want to set up your business first, maybe 5, 10%, and then as you get more established, then start to lever into the 20 percentile.
Yeah, okay. Yeah, that's a good point about time. And we're actually going to get into that a little bit on the compounding interest example. You have a fantastic example. We'll get to that in just a little bit. I think one thing that some people get caught up on, entrepreneurs and individual investors alike, is knowing which account to open first, investing account. You got your RSP, you got your FHSA now, TFSA, all these acronyms being thrown at you, and it's almost like you get analysis paralysis. So where would you think an entrepreneur would probably want to start if they had to choose one account to open first and focus on that one and then proceed from there?
I'd say maybe unconventionally it's TFSA right off the bat. Only benefit, the major difference there is tax exemption versus tax deferral in an RSP. So that'd be the go-to. Okay,
so TFSA, and you get the flexibility, obviously, of being able to put money in, gross tax-free, and then you can withdraw it too without any kind of tax consequences. Let's say I fill that up.
Yes.
What do I do next? What's your approach to, I guess, juggling all the accounts?
Yes, unconventional again. So then for me, it's going to be in my corporate account and not my RSP, which might turn some heads. The reason is 70 odd years ago when the RSP was established, it was traditionally you would go to work for, let's say, 40 years. At age 65, you would retire, and typically upon retirement, you don't have any other asset streams or revenue sources. So your income then is lower, and your taxable bracket then, therefore, lower. You pay less in taxes. Makes sense. But nowadays, at least for me, I believe based on the business that I'm establishing now, which will grow hopefully in the future, I might be in a higher tax bracket at age 65. So if I contribute to my RSP, yes, it gives me some tax deferral and maybe offset my taxable bracket by dropping me down a level, but then I might be taxed at a higher rate later on. So it doesn't make much sense to me, and there's less control with that than a non-registered fund. So for me, TFSA, non-registered, and if it makes sense, if it's cash filling over and I have just some contribution room, speaking to my accountant, of course, then I might contribute to my RSP.
Right, and the idea here is that you don't want to get into a situation where your RSP grows too large, and then when you convert it to a RIF and you have to forced to take out money, that you end up having a lot of income that you have to pull out of it, basically. You like the control factor of,
I do.
of things, yes, especially since you have all these different revenue streams, right? So that makes sense. One of the things that an entrepreneur can do, a small business owner can do, is set up, to your point, a corporate account. This is a non-registered account, so any income that you earn in it is going to be taxed annually. But there are some benefits to it. So talk us through some of the benefits of a small business owner opening up a corporate investing account. Why do you like to do it?
The control factor. So there's certain registered plans where you have certain, not obligations, but restrictions as to what you can invest in there. Whereas and the amounts, there's only contribution rooms. Whereas a non-registered fund is unlimited in terms of the contribution room, but you have to pay tax on that. The tax can be different. Speak to your accountant, depending on what province or jurisdiction you're in, might be upwards of 12%. So that might offset some of the personal gains you might have. So that's where the two, control and then some of the tax implications, are the two main benefits of having a corporate account.
Yeah, and I mean, to have the corporate account rate of like 12%, I believe in Ontario it's something like 12%, that sounds a lot better than a lot of the other rates that you could pay on your income too. So I just want to go back to the RSP for just 1 second there. When you use an RSP as an entrepreneur, you're trying to contribute in a way that will bump you down a marginal tax bracket. That's pretty much the strategy?
Yes, for me at least.
Yeah, talk us through a little bit about like that. How do you know how far to go with it, I guess?
Yeah, this is where a qualified accountant comes in your corner.
Sure.
And you're like, okay, if I contribute X amount, what is my tax bracket drop down and what's the tax I have or I save? And then what is that opportunity cost of that tax saved to invest? And does it make sense for me to pay that amount of my money where I can invest it elsewhere with a little more control to drop me down a tax bracket and grow that at a certain rate? And it's a lot of math behind it that way.
Yeah. Okay, so crunch the numbers for sure. Speaking of crunching the numbers, we have a fantastic chart up here that I want to have you talk through, this magic of compound interest. This is one of the things that you really preach to entrepreneurs, and that's to start investing early and as often as possible, realistically, that you can once you've sort of got things established. Talk us through this example that we're seeing on the screen here with Jack, Jill, Jacob, Jenny. That's a tongue twister, but talk us through what we're seeing here.
You can tell I like alliteration, right?
Yeah, clearly.
So what I've started here is to show a comparison between 4 individuals starting at different ages in life. And that's very realistic because we all start at different ages. So Jack's going to be starting at age 20, Jill 30, Jacob 40, and Jenny 50. They're all going to retire at 6 years old. So their time horizon from when they invest to when they retire is different. So Jack has 40 years, and if you go way to the right, Jenny has 10 years. But we're going to make up for the lack of time by the initial contribution amount. Let's say Jack, young 20-year-old individual, got a retirement plan from his Aunt Agatha who passed away, the inheritance, $10,000. Jenny, seasoned professional, been working for 30-odd years, amassed a huge initial deposit of $500,000. So that's 50x of Jack. And you're like, okay, Jenny has 10 years, Jack has 40 years. Let's assume they're going to earn 7% net of fees on their return on investment. And you're like, who's going to have the most in their account at age 60? And lo and behold, despite Jack starting with 50 times less, he's outpacing Jenny, both by 2.7 compared to 1.1. It's doubling. This is because of the time, not so much the contribution amount.
Yeah, I think that's absolutely mind-boggling for a lot of people. I don't think people appreciate the power of compound interest until you see it laid out in a great example like you've done here, because you would think intuitively, Jenny starts with $500,000. Of course she's going to end up with more money. I mean, to compound that for a little bit, but don't underestimate the value of time, right?
Huge. And for my math nerds out there, you're probably going to answer this. Yes, there's a certain amount Jenny can start with that will outpace Jack, but it's going to be an exorbitant amount.
Yeah, I mean, and to that point, like you have to contribute so much more originally if you start later. So you can actually save yourself a lot of money and perhaps take that money and reinvest it in your business instead of doing what like a Jenny did and have to wait so long and then start getting investing. It can be a real drag on your overall portfolio here. So powerful stuff, a great example. I love that. I'm just curious, like what do entrepreneurs have to say when you show them that example?
Unfortunately, they just look down with their head between their legs, like, oh gosh, I got to start. And they say it's too late. It's not too late. Yesterday was too late. Today's the perfect time.
Yeah, that's true. I mean, it's never too late. Something is better than nothing, of course, right? Another tip that you have for entrepreneurs, and I think this one will resonate with a lot of people, is to keep investing simple, low cost.
Yes.
You got a lot going on in your life, right? So, and all these other things you might have to be managing. How do you like to keep it simple and low cost?
I think the easiest way for most people is an index or an ETF with low fees attached to it. Think about you running and your journey to personal finance is running through. If you have a big parachute on your back pulling you down and that drag is slowing you down, that is the cost. You'll feel it, maybe not initially, but over the course of the time, you're like, oh, I can't even pull this parachute anymore. It's pulling me back. That's where the cost eats into your returns. And something as insignificant as maybe 1%, you're like, it's 1%. Show the math. I'll show you what 1% looks like. Upwards of 30% if you extrapolate long enough.
Yeah, no, it can get really nasty really quick, especially on larger amounts of money as it sort of compounds. Compound interest works the other way too.
Correct.
Fees compound. I think some entrepreneurs too, they might be hearing what you're saying. Okay, I got to get going. The compound interest is great for me. I need to cover my butt in retirement. But I'm hearing all these terrible headlines about recessions coming. There's going to be some kind of war or cataclysmic event, and I want to hold off until things settle down. What do you do to manage all that uncertainty and keep investing through all the craziness? What's your approach?
And I feel you. Humans hate uncertainty. We equate it to fear. So our first thing is to kind of go to the fight and flight response that's going to be harmful to us. So take that away. Take the emotion out of investing away. I think it's one of the wisest things to do. And how do you do that? It's just keep investing. And a simple way to do it is this fancy acronym called DCA, dollar cost averaging. You get paid every 2 weeks. So on that given Friday, you take X amount from your checking account, put it in your savings account, set up the automation. Then it buys a certain X, Y, and Z asset every 2 weeks. You'll buy the highs. You'll definitely buy some of the lows. And over time, it smooths out that way. And guess what? You can sleep well at night because you don't know when to time it. When are you going to buy it? I have no idea. When are you going to sell it? I have no idea. So take that out of the equation.
Yeah, I mean, the thing with having to buy and sell and try to time the market like that is you got to be right twice. And that is very difficult. And if you ask my wife, I'm not right twice very often. So it's a very difficult thing to do. We have a blogger coming up on the show in a couple weeks who we've had on before, Nick Majuli. He does a great blog of dollars and data, and he has a great quote from one of his books that says, even God couldn't beat dollar cost averaging. And what he means by that is, like, even if you got the perfect bottom, the perfect top, all that time that you missed not investing, as you do with the dollar cost averaging approach, you would actually have ended off worse if you were, let's say, using the S&P 500 as a benchmark here. Incredible stuff to think about, where you could take the thinking out of it, take the emotion out of it, and still end up doing better than somebody who's stressing about it and trying to figure things out, right? Of course, speaking about indexes, of course, we spoke with an early retiree, Jackie Cummings-Koski, recently, and she was talking about her love of this strategy that we've seen people do, basically S&P 500 and chill. Okay, all I'm doing is I'm contributing to this one index fund. It's done so well over the last 15 years. Why wouldn't I invest in it? Let's hear her rationale for why she likes the strategy so much.
You want a little bit of balance, but you don't need all these different, asset classes and sizes of stocks and things like that, because something like an S&P 500 index fund or total stock market index funds, it has a lot of diversification within there, even perhaps a lot of international, because a lot of these companies that's inside these funds, these stock index funds, they have huge international exposure. And most of their growth is probably internationally, where they have maxed out maybe in the US and Canada.
Very eloquently said by Jackie, but Robin, what do you think? Can an entrepreneur, small business owner, can they S&P 500 and chill their way to retirement?
They can, with a little caveat. I'm a big proponent of knowing what you own, so understand what is inside the S&P and be comfortable with it, and then understand your time horizon. If you're, once again, retiring in 10 years, your investment approach might be quite different than someone who's going to be retiring in 40 years, and your averages might be different. You might not be able to earn that quote-unquote a 10, 11% that the S&P gives you back in 10 years' time to meet your retirement. You might need something a little more risk asymmetric, potentially, for the 40-year term.
So for someone who is an entrepreneur and they're thinking, I like the idea of S&P 500 and chill, like, well, what kind of time horizon do you think they might want to have for that kind of strategy to work out?
Definitely longer, not within 5 or 10 years.
Right.
Definitely longer.
And even though you have a long way to go to retirement, you don't just S&P 500 and chill. You like to diversify your portfolio too, right?
Correct.
I want to get into some of the ways that you like to diversify your portfolio. We talked about it a little bit earlier. We teased people with the fine wines and liquors. So let's get into all these different streams that you have. How do you like to do it?
I look for control and liquidity as the main thing, and some asymmetry with terms of the upside of it. So I know that fine wine, fine liquor, I know nothing about it. Absolutely nothing about it. Okay?
I know it's delicious.
Yeah, you could say that. I don't even know that. If it's beer, different story. But fine wine, liquor, I don't know anything about it. But what I do know is uncorrelated to traditional assets, stocks, bonds, real estate. Okay, so it helps hedge in market uncertainty. also I know that I can't touch it for 3 to 10 years. So when I give that money over, I know I can't pull upon it, which is behavior he tells me, Robin, I can't even pull it upon it, so don't even look at it. Let it do its thing. Okay, so that's fine art, wine, and whiskey. The upside isn't huge, but it's a hedge against my traditional assets. Then there's something like Bitcoin, which is quite polarizing. Bitcoin has the possibility or propensity to go up X-fold if you invest in it. It has lots of volatility and lots of risk. Risk is the permanent loss of capital. Volatility is the intraday change of the prices. I'm comfortable with the intraday change of the prices because my time horizon is out many years. Same if you bought real estate. It'd be quite volatile if you're going to sell it in a year. You would think totally differently about your real estate portfolio. You're going to sell it next year. But you're saying, I'm going to live in for 20, 30 years. That volatility kind of goes out of the way. And you're like, okay, I'm fine with going down 20% because it's going to go up 30%. So between my real estate portfolio, which is traditional, stocks, bonds, traditional, I try to offset it with uncorrelated, illiquid, so it's less temptation on me, and then asymmetric in terms of the upside.
Now, you talk about long time horizon being obviously one of the keys to having you get comfortable with that. But is that all there is to it, or do you feel like an investor has to have a certain type of personality or risk appetite, I guess, that's outside the norm to do all that kind of stuff?
Oh gosh, yes. You need a different a risk appetite, and for me, it's the fear of regret. I spoke to you earlier, like, hey, I want to be in a position where I have the choice of wanting to work versus needing to work in 1.5 years. I'll be 40 years old. And that's a lofty goal and unconventional by many standards. But to get to unconventional goals, I have to do unconventional things. And that is taking certain bets on myself and being okay with it. And I know if things were to change, I have the ability to earn that income back later on. But what I don't have is saying to myself at 50, that I should, I could have, would have done this. And I can't go back in time and do it. So that regret scares me.
How big, I guess, would you say these alternative assets, let's call them, that you've diversified into, like how big a portion are they of your total portfolio?
Since the ebbs and flows of certain assets, it's about 14%. But it started 5 years ago at 1%. So it's gone significantly in the last 5-6 years. But it's not a huge proponent of it. Yeah. Not yet. And
would you be comfortable like having it become like a bigger portion, or no, you like to keep it fairly contained?
I don't mind being a bigger proportion. I think I'd be stopping out at 30-40% if it got there.
Okay. So try to maintain the diversification across all these different asset classes. Don't let anything, regardless of what it is, get too big.
Yeah, don't put all your eggs in one basket if you're going to use that analogy.
Right. Makes sense. Makes sense. Okay. The other thing, too, that you touched on there is that you are a real estate owner and you have rental properties and stuff like that. I think that is the more, I guess, traditional alternative asset for a lot of people. For a long time, it was going great. Things have taken a little bit of a turn recently. I'm curious, as someone who has had to manage a small business and do all your entrepreneurial ventures here, is real estate still something that you think, if you could go back in time, you would get into, or is it more trouble than it's worth? I think a lot of people are kind of wrestling with that right now.
I wouldn't change things if I go back in time, because things have changed over the last X amount of years that I've been investing. It gives you a lot of benefits of real estate. One of them is being leverage. If you do it well, you have cash flow, which is crucial. I don't think you should guarantee or think about appreciation as in your equation. Think about cash flow and paying yourself a certain amount every single month. But then it gave me leverage to take on more ventures and more possibilities. However, now things have changed a little bit from when I first started investing. The political climate's a little different. The economic uncertainty is a little different. Property rights and taxes are a little bit different. The control of it is a little bit different. And for me, I look at it as opportunity cost and hassle factor. If I have $1, which gives me the best return with the less hassle, or the least amount of hassle? And that's what I base it on. And real estate can be a lot of them came up for big fixes, roofs, ACs, furnaces. That's a lot out of pocket. Like, oh gosh, I got to do all that. So it's a little bit of hassle that way. And can my money be treated elsewhere differently? And for me, there are some opportunities, yes.
Mm-hmm. Yeah, I mean, everybody hears those horror stories about nightmare tenants, or like there's like some huge repair that has to be done and stuff like that. I think the misconception is that a lot of rental properties is passive income. It ain't all that passive. It can be for a time until it's not, right?
Absolutely not. My wife will tell you, when we were in Arizona a couple weeks back, I got 3 calls from the tenants. Everything went down in the wrong week. And they're like on your vacation trying to solve problems. It's not passive by nature, but with anything, there's trade-offs. And that was one of the trade-offs.
Isn't that the life of an entrepreneur? always having to jump on the next crisis and stuff like that, because ultimately you're accountable to yourself and yourself only, right? Your business. Great stuff, Robin. There's so much great tips we have. We have a lot more to get to, including our live viewer Q&A, which I'm really looking forward to seeing what people have to ask about. But just a quick note to our viewers here. If you're enjoying the show so far, make sure you check TD Direct Investing out on social media. We're on YouTube, we're on Facebook, we're on Instagram. You can see the QR codes on screen. You can scan them and they'll jump you over to our pages. Give us a like, give us a follow, a subscribe, all that good stuff. We have upcoming episode sneak peeks for you. We have a ton of other visual content here, video and static, that can help you level up your financial knowledge. And we also, speaking of great content coming up, we have a new episode of the Money Talk podcast. Let's hear a little bit more about it.
You talk about that when it comes to longevity, genetics has less to do with how long you will live versus your capacity for joy.
It is easy and common to look at someone who's thriving in longevity and say, wow, what great genes that person has. But the reality is that the research shows this, that genetics predicts about somewhere between 13 and 25% of our aging experience, which means the rest is up to us. A long life, even a long life in good physical health, doesn't mean much if you don't love your life.
You can find the full conversation and a full list of past episodes of the Money Talk podcast on Spotify and Apple Podcasts. I know I'm going to be tuning into that one because, I'll tell you what, Robin, I'm feeling old these days. Anyway, we're going to get to our live Q&A in just a moment here, but before we do, I want to bring in my colleague, Caitlin Cormier, because she's going to show us how entrepreneurs can get started building a diversified portfolio in Webroker like Robin and I were talking about. Caitlin, welcome to the program. Always lovely to have you.
Yes, absolutely. Thanks, Rob.
So Robin and I were talking about using index funds as, potentially a core to an investment portfolio. How can investors find these index funds that they might want to consider on Webroker?
Yeah, so index funds are able to be found within Webroker. We have a great tool called our screener tool. So let's hop right into the platform. We won't waste any time and we'll see how we can filter through. So I'm on the page right now. You get here from going to research, over underneath tools, and click on screeners. And then once we're here on this front page, there are some, like there's a stock screener here. If we come over to the ETF tab, we can actually create our own custom screen of ETFs. So I'm going to come over here to the right side, create custom screen. Based on what we talked about today, one of the first things we want to add here would be index. So we're looking for only indexed funds. We also talked a bit about that management expense ratio. I know there was like a bit of conversation around, making sure that it can eat away at your portfolio. So maybe you're looking something with a kind of below average or lowest management expense ratio. I am just going to deselect mutual funds there to filter us down a bit further. And then finally, let's just go into a category here and let's choose, let's just go with Canadian equity for the sake of filtering us down further. And you can see we've gone from, quite a number of ETFs that matched our kind of initial criteria, but by the end, we only have 33 left. Once I click view matches, it's going to spit out at me all of the ETFs that are available to trade that meet the criteria I had input. And then once I see them, I can kind of go through and decide what type of ETF specifically within Canada I'm looking for, whether it's, one of these S&P TSX 60 index ones or something else. I can rearrange them based on, which fund company they're with or, management expense ratio. And I can click through as well and see, how long the fund's been around for, different performance information. So quite a bit that we can do, including like side-by-side comparisons of up to 5 funds.
Okay, so lots of info there to get us started on the core of our portfolio potentially here. Robin was also talking about how he likes to diversify into alternative assets. How can investors search for some of these alternative assets on Webroker? Of course, not all of them are publicly traded. I don't know if there's a fine wine ETF or something like that, but what alternative assets can they find on Webroker?
Yeah, I'm with you, Rob. I don't think that I could do the whole wine, having wine in my cellar, but we certainly can look for some of those more specialty ETFs like, cryptos and stuff like that. So let's hop back into the platform and see. So with the screen that we have right now, we can actually go back and start from scratch here. And we can kind of go, I'm just going to remove these, the first one there, but I can actually choose, there is, like alternative other is one of our categories. I'm going to take out the Canadian equity piece and just put alternative other there. I'm going to take out the MER stuff because it looks like it's really filtering me down quite a bit if I do that, because they are more specialty type ETFs. So we'll just say maybe average. Oh no, they're going to be higher than normal management expense ratios on these ones. But once I do that and click through, you'll notice there are quite a bit of different, like a lot of these are coming in with different Bitcoin ETFs, but lots of different interesting categories. So if there is something in particular that you are looking to dive into, that could be one place to find it. And one other thing I'll say, that first page that we came to where we saw that with stock screeners, this actually does have some categories. So for example, Bitcoin ETFs is one of them. And there are kind of different areas within the market. You can see different specialty areas. So if, for example, you were looking for something in the Bitcoin area, you can click there and get it to spit out 30 different Bitcoin ETFs, for example, that you could do further research in and see if that's something you'd wanted to add to your portfolio.
Okay, so lots of stuff to get us going here. Caitlin, when I start my short-lived whiskey and wine collection here, I'll have to have you over for a drink. We appreciate you joining us as always. That is good. TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. Okay, without further ado, it is time for our live viewer Q&A. Robin, you want to hear what people want to know more about?
Absolutely.
All right, I believe Jimbo has a question for us here. Let's see what he's got for us. Jimbo wants to know, how did you get into those specialized business opportunities, such as like we were talking about, wine, art, private lending? How did you research them, and what guided your decision making when choosing which ones to pursue?
Yeah, it got to networking. You put yourself in positions where you surround yourself with people who want to pull you forward, and they have a certain like-mindedness. They think differently than the typical crowd in that respect. And a lot of my friends, through networking, through real estate conventions or Bitcoin, talked to me about other alternative assets. And then it was me up to looking up the process, whether it's online or through podcasts. And once I'm familiar with that, then I'm looking at putting a little initial investment, see how it works, talk to the company, see how that works. And then once I'm comfortable with that, put a little more capital there. When it's private lending, it's really much a trust thing. So over the years, you build up trust with individuals you're quite comfortable with. You know how they operate, and then I'm comfortable setting up certain terms. Usually, it's earlier on. It's maybe 1 or 2 years to see how the process is, and maybe something more extended that way. But that's the private lending was definitely relationship building, and then the networking taught me about the fine art, wine, and whiskey.
I know this is a bit of an existential question, if you will, here, but there's so many potential investments, alternative into assets and stuff like that you could get into. How do you suss out one that seems promising from one that, you know, if not a scam, it's kind of, I guess, a little bit more dubious as to whether it could truly diversify your portfolio in a way that you want?
I think there has to have an investment opportunity and a use capability. So for frying wine and whiskey, at worst case, I can draw upon it and drink it and consume it. So that's a secondary use. The upside of it is it's a non-correlated asset class that kind of goes inverse to what stocks and bonds are doing. So if it has use case on top of that, and you can actually make the case for it, that you understand it, versus something more esoteric, then I'm more comfortable with doing that.
Okay. So, but obviously it takes a lot of research to look into these things.
Oh gosh, yeah.
How long did it take you before you got to the point where you're like, I'm comfortable investing in, we keep coming back to it, but the fine wines and whiskeys,
Probably 3 to 6 months.
Okay.
I had conversations with the company. I had them on the phone. We emailed back and forth. I did some more research. Then I gave them some capital, see how that works. So it took some process there.
Okay. So not something to rush into, but if it fits the bill, something to consider for sure. Tia has a question for us. Let's get to Tia's question. Tia wants to know, I've noticed many small business owners hold their brokerage accounts inside a holding company. What's the purpose of that, and what are your thoughts on that?
Yeah, that's correct. It keeps it separate from your personal accounts, so you want to make sure your money never commingles between the two. And there's certain fees or obligations that you can have inside your business account versus your personal account. And then in terms of the business account, then you separate in terms of tax obligations as well.
How did you get to the point where or what conversations did you have to get to the point where you knew that it was time for you to set up like a corporate account and the type of structure that you had for your business? Like, how did you come to that?
When I got to the point where I didn't know what to do with some of the money, where I was like, okay, I made my obligations, expenses, I have my emergency fund, I've maxed out some of my registered accounts. What do I do with this? And how is it going to earn me the most on that opportunity cost, back to that example? Then I'm like, what are the opportunities available to me? Talk to your friends, talk to your banker, see what opportunities are available. That's where the corporate account came in.
How long did it take you to set up all that stuff? Was it like a whole long process? I know it was years ago. You're reaching into the memory bank here, but
it probably took me about 6 to 12 months. I talked to colleagues before me and said, okay, how'd you do this? And then I talked to my accountant. We had many meetings back and forth, and we decided to go through it, 9 years ago. in that process.
Wow, okay. We have another question coming to us from Kayla. What does Kayla want to know? Kayla's saying, how do you do your networking? Hey, great question.
A combination of ways, whether it's Zoom calls, now more present. Back in the day, it was going up to meetups. You talk to one of your friend you made, and they told you about this idea. And guess what? On Facebook Marketplace, they're having this meetup. So I went to that meetup, showed up, didn't know anybody. But you're a physiotherapist. You're meeting strangers every single day. So meeting new people wasn't a challenge for me. So I met people, and then you keep in touch with them. And guess what? At the next meetup, you see them again. And over the course of years, network. Guess what? That person knows Bob. Bob knows Sue. Sue knows Nancy. And before you know all three of them.
Yeah, it takes on a life of its own, and
Incredible.
things start coming to you, right?
Correct.
Yeah, that's interesting stuff. Good question there, Kayla. Bardish has a question for us. Let's check out his question. What are some of the biggest investing mistakes you made as an entrepreneur before you whipped yourself into financial shape? Okay, what do you got for us, Robin?
Yeah, whether it's something as simple as losing money, something is not forecasting particularly well, not having an exit plan in mind, or entrusting people inappropriately with your funds and therefore your time. So not doing the research, not planning for expenses, not knowing when to exit and how to exit and what that time frame looks like, and assuming everybody has your best back, and they don't.
Robin, I think you got a story behind that. Putting your trust in the wrong person, what do you mean by that?
It wasn't anything malicious or nefarious. It was more of they gave me suboptimal returns, promised me higher returns. And yes, I got returns, so I didn't lose money, but I lost time, which is invaluable based on our compound interest example.
Right.
So for that, I felt disheartened because I thought they were working in my best interest. My fault, I didn't ask the necessary questions, didn't do the necessary research, and I got suboptimal results as a result of it.
I know some folks who might have some kind of relationship with some kind of like financial planner or somebody like that, or somebody like who you're describing. They want to break up with that person, and they want to do it themselves, become a DIY investor. How did you have that conversation with that person when you realized that this arrangement isn't working for me?
Frankly, I just sat them down and said, listen, these are my goals. These are what I'm trying to aim to do. This is what happened in the past. I don't think we're aligned on the same goals or privileges. Plus, on top of that, I feel more control when I manage the money myself, and I have the aptitude or the control to do so. So what I'm going to do right now, I took the whole amount out of that one brokerage to another one. But you can do a little bit first, and then show that person, look, you spent 6 months. This is my return. This is your return. And now I'm going to take the all amount because clearly I'm doing this better right now for you.
Mm-hmm. I know another one that you've talked about in the past is not using your TFSA the best way that you could have, making some investments that didn't really work out for you. Yes, I know, a painful memory, I'm sure. I know, a painful memory, I'm sure. But I think it's really instructive if you wouldn't mind sharing that story, because I think it's a mistake that a lot of people could make.
Absolutely, yeah, and I'm more than happy to share with it. So, what time is it now? Probably 8 years ago, I put myself in a syndicated mortgage inside my TFSA to purchase an apartment building. That purchase never came to fruition. So the actual corporation that held my funds went into receivership, and I basically got paid 10 cents on the dollar that I invested in. And that's a permanent loss of contribution room inside your TFSA. Guess what? That amount is great tuition to my future results. So am I going to make the mistake again? No. Have I learned from that? Yes. Are my learnings and opportunities greater than the loss? Absolutely.
I guess the takeaway there is like, be careful of doing speculative type kind of investments in a TFSA.
And following the crowd. That was me. I didn't ask the right questions again, look at that again, and I followed some other people's investment thinking it was a sure bet.
Okay. We learned from your mistakes, Robin. We appreciate you sharing that story with us. Aaron has a question for us. Let's check out Aaron's question. What would I need to think through with my investments before I pass the family business down to my son?
I think the easiest one that we all face is tax obligations and how that's treated. Okay, we know with TFSAs, if you're transferring over, being a success holder versus beneficiary has different contribution rooms and availabilities to that. Same with an RSP. So being mindful of when I pass the next of kin, is there any friction or drag in terms of taxes? And if so, how do I mitigate that or reduce it? And then are there any obligations that you have to do outside of that?
I mean, a lot of this tax stuff can get complicated. How could somebody navigate that? Where should they go to figure this stuff out?
I wish you had my accountant, but I don't think he's taking any of our clients. But having a nice, competent accountant who knows your business, has been there before, and knows a good idea of the tax code. So someone in your favor that way. That's huge for me. Invaluable.
Yeah, I mean, it's hard to give like sort of general commentary on all these tax things because everything's so specific.
So specific.
Yeah. Jaga has a question for us. Check this out. How do you like to budget as a small business owner?
I'll take it as in the process of budgeting in terms of using the software. I budget every 2 weeks. I sit down on a Saturday morning, cup of coffee. In the golf season, no, because I'm golfing Saturday morning, but other times, Saturday morning, cup of coffee, and I reconcile all my accounts. And I know exactly, oh yeah, I spent this 2 days ago. What was that for again? Let me reconcile that well. So in 6 months' time, I don't look back and say, hey, what is this expense for? And when I do that, it teaches me about my habits, because where you put your money is where your habits are. So I said, oh yeah, maybe I should have gone for takeout so often this past 2 weeks, because guess what? My balance is running low. So I'll do it every 2 weeks because I want to navigate correctly versus checking it once a year. So that's my, and it's software based. So it's auto fetching on certain software. I won't give the names, but there's plenty out there where they can pull up your bank feed and auto categorize where you're spending the money. And you can see based on seasonality or time of year where your money's going. So that's the easy part of it. And then actually checking is more of the hard part because it takes a little more behavioral change.
Well, I think a lot of people might not want to be checking every 2 weeks because they might not like what they find, right? I think budgeting can be a lot like dieting in the sense that like it always feels like it can be a tomorrow problem because I don't want to diet right now. I want to eat the chocolate candy bar, right? How do you get the motivation to be that on top of things? And I think most people would rather do it like almost like a spring cleaning type of thing. I look at it once a month and I figure things out. But you're doing your budgeting very frequently. How do you get up for that?
I guess that's that unconventional goal, retiring earlier or taking a step back. And I can make mistakes, but I have to be on top of it and being okay with making mistakes. Make mistakes not because of omission, because I did something incorrectly. So that's why it just fuels me. I got to make sure I'm on top of it, not neurotically, but enough that I'm on track that way.
Okay. I think we have time for one more question. Shireen has one coming to us. Shireen says, when does it make sense to incorporate, in your opinion? Okay, this is a big question, but talk us through maybe, again, it's hard to give like a sort of a general advice here, but walk us through how you came to that conclusion.
Yeah. Thank you, Shireen. I thought I would avoid this question. It came to me after a few years of working in my profession, if it made sense for the uplift of spending the time on accounting fees, spending the time on legal fees to set up my corporation, which helps me reduce my tax obligation in a given year. And there's a certain magic number out there that you and your accountant can come to in terms of earning potential. At that number, does it make more sense to be classified in your personal tax bracket and pay an X amount of taxes? Or do I spend more on accounting fees and set up my articles of incorporation legally? That cost, that offsets the potential gains of future taxes.
So, I mean, I imagine you have to have like a pretty decent amount of revenue coming in to make that worthwhile. Like, do you have like a ballpark figure maybe? I don't know.
Thank you, Rob. For me, 9 years ago, it was $100,000. Okay. Now, inflation adjusted might be $125,000.
Okay, but we're talking like probably six figures.
Probably six figures.
Yeah, okay. Appreciate the perspective, Robin. This has been great stuff. Lots of rapid fire questions here and follow-ups and stuff. Handled it like a consummate pro, so well done. Unfortunately, time beats us here. But any parting words of wisdom that you want to share with the audience before we let you go?
Delay gratification as best you can. Think about your future self now so you can take action today, because in 15 years' time, you can't go back and change that right now. And I assure you, your future self will thank you for taking those small steps today for later.
Yeah, and it's almost like approach investing almost like an entrepreneurial venture in a lot of ways, right? Like you have the passion to set up a small business, try to apply that same passions to investing, of course, right? As you have done, and it seems to have worked out beautifully for you. So
thank you.
Congrats to you. Yeah, exactly. Knock on wood. Well, thanks again for joining us. And of course, to our audience, thank you for tuning in as always. A little bit of a sad programming note here to leave you on. Our producer, Ryan Masad, who's been an absolute staple for us for many years now on this program, is unfortunately moving on to greener pastures. We're happy for you, Ryan, but we are admittedly devastated. I know I am. I won't talk too much because I'll probably break out into tears here, no jokes, but Ryan is the glue guy in the background. He always has been, making sure that everything's running smoothly, including getting your questions to us so that we can address them in a timely manner, making sure everything with the registration pages and all the technical stuff that is way over my head is running smoothly and makes the show fantastic. Ryan, we're going to miss you dearly. Best of luck in the future. Like a glue guy, can you stick to us and make sure you stay in touch with us when you've moved on to greener pastures here? We would really love that because we've appreciated you so much. Thank you for all the work that you've done in that time. For our viewers, though, of course, the show continues. The show must go on. We do have a show for you next week, and we have a good one. It's a little bit of a controversial topic. You want to check it out. Do you need to rethink your asset allocation? We're going to be digging into Vanguard's controversial suggestion that a 30-70 portfolio, 30% stocks, 70% bonds, might outperform in the next 10 years. Really interesting stuff. We have our guest from Vanguard who's going to break it all down for us, so you don't want to miss that. That's all the time we have for this edition of the show, though. From everyone on Inside Investing, thanks so much for watching. We'll see y'all next time.
Have more questions? Check out the links to the right and in the description below.